This is lecture 4 in Principles of Management Accounting. Today we're going to talk about cost system refinement. So following on from last week where we talked about job costing, we're going to now talk about how to refine our job costing system using departmental overhead allocation rates. Next week we're going to talk about activity-based costing, and the following lecture we will talk about process costing. So it's all part of learning about costing systems. Today what we'd like you to understand is how normal costing with a plant-wide overhead allocation is calculated using alternative denominator capacity concepts. So remember, normal costing is when we use actual materials and actual labour, but we calculate a budgeted overhead rate and allocate it using the actual use of the cost allocation base. We want you to understand the purpose and criteria of cost allocation and understand traditional costing system alternatives for allocating overhead costs using either plant-wide or departmental rates. The refinement of a normal costing system using departmental rates and a two-stage allocation, we want you to know how to do this. So we want you to be able to allocate support department costs to production departments and then allocate from the production department to the product. So we're going to talk about guidelines for this cost allocation, how we choose the allocation base, the allocating costs by behaviour, so whether we use a single rate or a dual rate method, whether we use actual or budgeted costs, and be able to recognise interdepartmental services using direct, step-down and reciprocal methods. So we're going to learn how to apply these methods. The refinement of the costing systems, we're going to talk about an introduction to activity-based costing, which we'll elaborate further on in lecture 5. So remember, normal costing is where we use actual materials cost, actual labour cost, but we calculate a budgeted overhead rate and allocate it using the actual use of the allocation base. And we can do that using a plant-wide overhead allocation calculated using different denominator capacity concepts. So what we mean by plant-wide is a traditional costing system where we just allocate based on one overhead allocation rate that we use for the entire plant. Recall that in order to calculate our product costs, we can only include the costs of production, our manufacturing costs, in order to cost our inventory, our work in process and our finished goods, and to calculate our cost of goods sold expense. We can't include administration, research and development, design and of products and processes, marketing, distribution or customer service costs when we calculate the product cost. For decision making, so things like pricing, we'd also need to include all the parts of the value chain in the cost of our output, but for the purposes of inventory and cost of goods sold expense, we can only use production costs. So you recall how costs are measured under actual versus normal costing systems. Actual, you wait till the end of the period and calculate an actual overhead rate, and you apply it using the actual use of the cost driver or cost allocation base. Whereas in a normal costing system, the only difference is that you calculate a budgeted or predetermined overhead rate to allocate the overhead to different jobs using the actual amount of the allocation base. So we calculate this budgeted overhead rate using the budgeted total manufacturing overhead costs divided by the budgeted quantity of the allocation base expected to be used for the budget period. And ideally that allocation base is a cost driver. What do we mean by that? It's a variable that causes the overhead costs to increase as it increases. When we allocate our overhead to a job, using normal costing, what we do is we take our budgeted overhead rate and times it by the actual quantity of the allocation base used on the job. So just to refresh your memory now, we're going to do a quick check question. Job number 53 at Manic Incorporated required $200 of direct materials and 10 direct labour hours at $15 per hour. The estimated total overhead for the year was $760,000 and the estimated direct labour hours were 19,000. So what we want to do is work out what the cost of job 53 would be recorded at. So remembering, we have direct materials, direct labour and manufacturing overhead that we want to calculate. So we know we're using normal costing, so the actual direct materials is 200. The actual direct labour is 10 hours times the $15 per hour gives us $150. And our manufacturing overhead that we allocate based on the budgeted overhead rate. So we first have to calculate the rate. That's the 760,000 budgeted overhead, manufacturing overhead, divided by the 19,000 hours, gives us a rate of $40 per hour. And we apply that by taking the $40 and timesing that by the 10 hours that we actually used in direct labour. So that equals 400. And if we add the manufacturing overhead that we allocate to the direct labour, to the direct material cost, we know that the cost of the job is $750. So that's just normal costing using a plant-wide rate, a single rate. And part of the issue when you're calculating your budgeted overhead rate is what is the size of the allocation base that we need to budget in the normal costing system. So we can choose a theoretical capacity, which is supply side capacity. So this is how much absolute maximum production capacity at full efficiency. So if we are working constantly at our full efficiency, this is how much we could supply, we could produce. The practical capacity is the maximum output if everything operates efficiently, but we allow for unavoidable interruptions. So it's theoretical capacity, less planned downtime, but it's really a supply side capacity. This capacity is based on demand. Normal capacity is the capacity the firm uses to satisfy long-run average customer demand. So it takes into consideration and averages out all the seasonal, cyclical and trend factors. Another demand capacity, so this is a way of choosing your denominator in your budgeted overhead rate. You might choose to use master budget volume capacity. It's different from normal capacity. It's still demand side, how much the firm expects to use to meet demand for the current budget period. So it's not a long run average, it's just for this period, what we expect the demand will be in this period. So all of these different capacities, supply side and demand side, can equal or not equal actual capacity. And that's when we get problems with overall allocation of overhead. So we're going to do a lecture example to demonstrate what we mean here in regards to this concept, denominator concepts, capacity concepts. So Thunderbolt Incorporated is a manufacturer of the G36 motorcycle. Management has recently adopted absorption costing. That means that both variable and fixed costs are included in the calculation of the product. Still only manufacturing costs. It's debating which denominator concept to use: theoretical capacity, practical capacity, normal capacity, or master budget capacity. The G36 motorcycles sell for an average of $8,200 per unit. The budgeted fixed manufacturing overhead costs for 2017 are estimated at $6,480,000. The company uses sub-assembly operators that provide component parts. The following are the denominator level capacity options that management has been considering to use as the denominator in their budgeted overhead allocation rate. So theoretical capacity, that's what they could produce if they never broke down, if they were efficient at all times. Based on 3 shifts a day, 5 motorcycles per shift, and working 360 days per year, they could produce 5,400 units. Practical capacity, which is also a supply side capacity, it makes a theoretical adjustment for unavoidable interruptions. So now we still have 3 shifts a day, but we're saying we can only produce 4 motorcycles per shift, and we only produce on 320 days per year. So our total practical capacity is 3,840 units. From a demand perspective, we predict that normal capacity, remember that's the long run average capacity, is 3,240 units. That's the number of units that will meet what we expect to be the long run average sales demand. The other supply side capacity is master budget capacity, and in this question they tell us that based on strengthening stock market and growing popularity of motorcycles, the marketing department issued an estimate of 3,600 units. So we expect to be able to sell in this period 3,600 units. So you can see each of these capacities has a different number of units as the predicted number of units that we can either produce or we can sell. So what this question requires us to do is calculate the budgeted fixed overhead rates under these 4 different denominator level concepts of capacity. Then we're going to talk about the benefits of using theoretical and practical capacity, which remember are supply side concepts. And then under a cost-based pricing system, what are the negative aspects of using master budget volume, which is a demand side capacity level, and what are the positive aspects? So firstly, calculating the different budgeted using the different capacities. So remember the budgeted manufacturing overhead in total is 6,480,000. If we're using theoretical capacity as our denominator, we divide the 6,480,000 by the 5,400, and our rate is $1,200 per unit. This is how much we're going to allocate to each motorcycle. With practical capacity, because our denominator level is lower, because we factor in periods where we're not as efficient because of unavoidable delays, that means our overhead cost per unit is going to be higher. Same numerator, lower denominator, overhead allocation rate will be higher. Our normal capacity, that's based on demand, the long run average demand for our product is lower again, so we have a higher budgeted fixed manufacturing overhead cost rate. And our master budget capacity, remember that's also demand side, is slightly higher, so we have a lower budgeted fixed manufacturing overhead cost rate than we would have if we used normal capacity. So what's happening here? What we're seeing is that depending on what you choose as your capacity level, it's going to influence the budgeted fixed manufacturing overhead cost rate that you apply when you allocate your overhead. So unless all your supply is used in relation to the supply side, you're going to either under or over allocate your overhead. So if you use theoretical capacity, but you only produce and sell 3,600 units, you're going to under allocate your overhead because you have created a rate that used a much higher denominator than you actually produce and sell. This signals a divergence between the supply of capacity and the demand for capacity. So if you have under or over allocated overhead and you're using a supply side denominator, it tells managers that there's either not enough capacity or too much capacity to meet demand. And this is important because the basis of fixed costs is that in total they don't change in the relevant range. And so having information that we've over or under allocated overhead enables managers to make decisions to manage the size of their capacity. And really this over or under allocated overhead is based on the fact that fixed overhead costs are lumpy. We make decisions so that fixed costs are fixed for a certain period of time and within a certain relevant range, and therefore they're lumpy. We can't change that in the immediate future. Under cost-based pricing, so what do we mean by this? Under cost-based pricing, we take these costs, the total costs for a job, and we either add on a margin or add on a fixed profit to get the price. And if we're using master budget volumes, that can lead to high prices when demand is low. So if our master budget says we're going to only have demand for 2,000 units, our overhead rate will be higher than if the demand is 3,600. And if we're using this cost as a basis for our pricing, we're going to have a much higher cost and therefore price if demand is low, because our denominator in our budgeted overhead rate will be low and therefore the rate will be higher. And that higher cost leads to a higher price, which can erode demand. What we mean by that is leads to fewer people wanting to buy this company's motorbike because the price is perceived as higher. Using a master budget volume also leads to low prices when the demand is high. So if we have very high demand for our motorcycle, that will mean that our budgeted level capacity using master budget will be higher, leading to a higher denominator and a lower overhead allocation rate. And if we're using cost-based pricing, that means that our price will be low and therefore we are foregoing potential profits on our motorcycles that we sell. We might find that our market share increases, but we'd look around and see that our competitors potentially couldn't meet our price, and we would start to think perhaps we were miscosting our product. Some positive aspects of master budget volume as the denominator level capacity concept is that the cost per unit is based on demand, and this price would be necessary to cover the costs. And master budget volume is a good benchmark for evaluating our real performance against. So if we found we had under or overhead allocated overhead, we could then look at what we actually achieved versus what we budgeted, and it would alert us to any significant differences that should have been managed by managers. So this downward demand spiral, we're going to just demonstrate that for you. Assume the following data for a manufacturing business. Annual production and sales are budgeted to be 10,000 units. The variable cost per unit is $200 per unit, so that's our direct material and our direct labour. All overhead is fixed and totals $1 million for the year. The business uses the master budget volume, which is this 10,000 units, as the basis for determining its overhead rates. The selling price of the business's product is set by adding 100% markup to the full product cost. So first of all, we want to calculate the budgeted selling price for the current year. So we know the direct material and direct labour equals $200. To that we want to add our overhead. So we're using normal costing, so we're going to create a budgeted overhead rate. So we're going to divide the 1 million by the 10,000 units. So that's $100 per unit. Times it by 1 to get the overhead per unit. That gives us $300. That's the cost. And we have 100% markup. So we add on another 300. So our sales price equals 600. So it's 600 for the current year. Now, if there's a revised annual production and sales of 8,000 units due to intense competition and a slowing economy, the revised budgeted selling price would still be the 200 direct materials and direct labour, but now our overhead would still be the 1 million, but now we're going to divide that by 8,000 units. Which gives us $125. So our total costs are $325. So our sales price now will be $325. So sales price in the second scenario will be $325 plus $325, so that will be $650. So instead of having a sales price of $600, because our denominator is now 2,000 less, our sales price is $650. So we'll probably sell less, which will mean that next period that denominator will go down further, increasing our sales price further. So this is what we call the downward demand spiral. If we're using a master budget volume as the capacity for our budgeted fixed overhead allocation base, then we have a problem when that budget and our pricing is linked to our costs, and if that denominator keeps reducing, our costs keep increasing, or the costs that we allocate to that job, and therefore our price keeps rising, which results in less demand, and that's what we call the downward demand spiral. So what is the purpose and criteria of cost allocation? What do we know to date? We know that indirect costs are not traced. That's the definition of indirect costs. They're not traced because it's not economically feasible to trace them to our cost object. So it's because the cost outweighs the benefit, and they therefore require allocation. This raises a question as to the accuracy of the cost of the cost object. Under normal costing, remember, we use actual direct materials, actual direct labour, but our indirect costs and the denominator capacity of allocation base are budgeted. Indirect costs now comprise a large percentage of total product costs in our contemporary production environment. Therefore, if we have inaccurate overhead allocation, this can have significant costs to an organisation with multiple products. So it means, as we've demonstrated previously, we might over or under allocate overhead, which can have an impact on our pricing if we're using cost-based pricing, and this could lead to a downward demand spiral. And therefore it's very important that we try to, as accurately as possible, allocate. So what does this mean for us? We need accurate cost systems to make good decisions about pricing, about how much product we should be producing, about what the inputs to that product should be. How can we increase the accuracy of our costing systems? So that what we call increasing accuracy is refining our costing systems. So how can we make them more refined or accurate? Well, firstly, we can try to trace as many costs as possible as long as it's feasible, economically feasible to do so. So try and increase the costs that we can trace to our cost object. Then what we want to do is refine our cost allocation system. So remember, to date we've talked about using a plant-wide cost allocation rate, so a single rate to allocate all of our overhead. But we can refine our cost allocation, and we're going to learn about that this week and also in Lecture 5. So some specific issues to consider when we refine are how many indirect cost pools shall we have? So currently we've just talked about having one manufacturing overhead cost pool, but it might be that that's not terribly accurate for our costing system. It might be that we have multiple cost drivers that differently affect different types of manufacturing overhead costs, and therefore we need to have a number of indirect cost pools rather than a single cost pool. We want to use appropriate cost allocation bases for each of those cost pools. What criteria should we use in order to achieve a more accurate costing system and a more accurate allocation of our overhead costs? So the purposes of cost allocation is to provide information for economic decisions. We want information about what it costs us to produce our product. We want to be able to use this information to motivate managers and other employees to make decisions that will mean that we are more efficient at producing our product. And we also need this information to justify our costs and compute reimbursement. So in some instances, we'll have contracts with our customers that they will pay us the cost plus a markup for that product. We have to know what that cost is. We also need this information to measure our income and assets for reporting to external parties. As we know, we use the information on the calculation of costs of jobs to inform the costs of our inventory, work in process, finished goods, and the cost of goods sold that we report on our profit and loss statement. And we know that under the standards, if we're doing external, that the cost of inventory should comprise all the costs of purchase, conversion, and other costs incurred in bringing the inventories to their present location and condition. The costs of conversion include the costs directly related to the units of production, such as direct labour. They also include a systematic allocation of fixed and variable production overheads that are incurred in converting materials into finished goods. So this is what we've been doing. We have been using direct materials, direct labour, and allocating our overhead to our product, our manufacturing overhead. And this is what we call, also referred to as absorption costing, because we include both fixed and variable manufacturing overhead in this allocation. So when we allocate these overhead costs, we want to use a cause and effect criteria. So the variables that are identified to cause resources to be consumed are the variables that we want to use as our cost allocation basis. We could also use benefits received. So we might allocate based on the benefit that a particular job or product receives So it might be the beneficiaries of the outputs of the costs are charged with the costs in proportion to the benefits that they receive. We might use fairness or equity, so we might allocate costs based on a price that's satisfactory to a particular government or its supplier. And this is more of an objective than a criterion. Cost allocation here is viewed as reasonable or fair means of establishing a selling price. Or we might allocate based on ability to bear. So costs are allocated in proportion to the cost object's ability to bear the costs. So if I know I can charge a higher price for product A, I might allocate more of the costs, the overhead cost to product A than product B that can't afford to bear those costs because I can't charge as high a price. Now the most economically plausible is using this cause and effect allocation criteria. So traditional costing systems, alternatives for allocating overhead costs. So we can use a plant-wide rate as we have in the previous lecture, a single cost allocation rate for our manufacturing overhead, or this is what we're learning about today, using departmental rates. So this is a more refined costing system where we're allocating costs based on multiple cost allocations. So allocation bases that are volume measures. The amount of the base changes proportionately with the volume of output. So things like direct labour hours, machine hours, or units of production. So volume bases often produce average costs, and that will severely under or overstate individual product costs and cause cost distortion. This leads to a requirement to further refine costing systems. So if I know that, for example, product A and product B use the same activities, then it's not a problem. But if they use different activities in different proportions, then using volume basis isn't going to reflect their use of overhead. And this information will be distorting the costs and therefore won't be as accurate for economic making. So as part of making our cost system more accurate, and we want to refine that costing system, we have to decide how many overhead cost pools and rates should be used. So using a plant-wide rate, that's just a single cost pool and a single allocation base to allocate all the manufacturing overhead costs to output. If we use departmental rates, that means we calculate multiple department cost pools and multiple allocation bases to allocate each department's overhead to output. So it's a more refined costing system. What do we mean by that? Well, in the traditional plant-wide method, we take all the indirect labour, indirect materials and other overhead, we accumulate those costs in a single cost pool, and then we allocate it to cost objects based on a single cost driver, in this case direct labour hours. That's fine if all your products look pretty well the same. They use the same amount of overhead. But in some cases, you have variance across products and you might need to refine your costing system, and instead of using a plant-wide rate, you then calculate departmental rates and allocate your costs from departments using different cost drivers. So in stage 1, you're accumulating all of your overhead costs in different cost pools for each department. And in stage 2, you're going to allocate to your products using different departmental allocation rates. For department 1, it's direct labour hours. For department 2, it's machine hours. And for department 3, it's raw material costs. So this is stage 2 of using departmental cost allocation rates. So a company manufactures 2 products, A and B, in 2 departments. So there's 2 departments with 2 processes, assembly and finishing. Budgeted costs of the departments and budgeted hours at practical capacity. So remember, practical capacity is theoretical capacity less unavoidable breakdowns. And they used to produce each product presented below. So for assembly, our budgeted overhead is 976,000, and the budgeted direct labour hours are 10,000. For finishing, budgeted overhead is 574,000, and budgeted direct labour hours are 10,000. So the direct labour hours required from each product. So product A needs 4 hours of assembly, 1 hour of finishing. Product B needs 1 hour of assembly and 4 hours of finishing. So based on a plant-wide overhead rate, we want to calculate the budgeted overhead cost of the two products, and then we want to do it using departmental rates. Direct materials and direct labour are irrelevant for the purposes of this illustration because we're using normal costing, so they don't change under the two different systems. So using a plant-wide rate, what we would do is take the total budgeted overhead divided by the budgeted direct labour hours, and using that rate, so the 1.55 million divided by the 20,000, the $77.50 per hour, we'd allocate to each of the products. So for product A, it used 5 hours in total, product B 5 hours in total, so they're both allocated the same amount of overhead. So that's using a traditional plant-wide rate. Now, is that an accurate reflection of the costs used by the products in the manufacturing process? Does it reflect actual usage? So by the costing system and using departmental rates, what we do is we create two cost pools, one for assembly, one for finishing, and therefore we can create two cost rates, allocation overhead rates. So we divide the 976,000, that's the budgeted overhead for assembly, by the budgeted direct labour hours, and we get a rate of 97.60. And for finishing, we divide the 574,000 by 10,000. That gives us 57.40 per hour. Now we know for product A, they use 4 hours of assembly and 1 hour of finishing, and product B is the reverse. They use 1 hour of finishing, 1 hour of assembly and 4 hours of finishing. So we allocate 4 hours of assembly at 97.60 and 1 hour of finishing at 57.40. So product A has 447.80 allocated, and product B, it's the reverse. They have 1 hour of assembly at 97.60 and 4 hours of finishing at 57.40. So they have a lower total allocation. So here, using the more refined system where we have two cost pools, one for assembly and one for finishing, we actually get a more accurate allocation of overhead that reflects the product's use of that particular department. So here, instead of just getting an average, we have a more refined or accurate cost, which shows us that in fact, under a plant-wide rate, product A was undercosted, too low, and product B was overcosted using the more traditional simple system, which means that product B was cross-subsidizing product A. So we end up with different product costs, even though both departmental rates were based on direct labour hours. And that's because the cost pool, the costs of each department, were differed. The use of the plant-wide rate leads to product cost cross-subsidization when indirect costs are consumed differently by the different outputs. So we saw that product A used more of the more expensive assembly and less of the cheap finishing than product B. So product A has been undercosted and product B has been overcosted using this simple system. The impact of that is potentially we were underpricing A and overpricing B. So by underpricing A, we're losing profits, and by overpricing B, we might have been losing market share. And we may not have been as competitive as we should have been. Okay, so what happened? Using the plant-wide rate, we got cost smoothing. So broad averages are assigned uniformly to cost objects when they actually use or consume resources differently. So it was less accurate. We just used $77.50, which was the average rate, to allocate all of the department costs across A and B. That resulted in product undercosting. So A was undercosted for the product that consumed relatively high level of resources, and it may result in unrecognised losses on sales. And product overcosting, so product B was overcosted, so that product that consumes a relatively low level of resources, so it used less of assembly, which was a high cost department, may result in lost sales from overpricing or the dropping of a product line that may appear to be profitable. So product cost cross-subsidization occurs where at least one product is overcosted while another is undercosted. So the refinement of this normal costing system using departmental rates and a two-stage allocation approach. So how do we deal with more than one type of departmental cost center? So a production or operating department is a cost center. It performs a distinct step or part of a production process that directly adds value to our product. A service department provides support that facilitates or assists the activities of the production department and other service departments. So it's not directly involved in production, but it provides support to that production department, things like accounting or administration or cleaning, repairs, maintenance. So we might find that our support department costs are added to the costs of the production department. So the production departments have support department, Department A and Department B, and Department A has overhead, and we allocate so that we get the total overhead of A and the total overhead of B included in our total costs. So calculating departmental overhead rates, stage 2. So we initially assign overhead costs to the original production department or service department, and then we reassign service department costs to production departments, and then we allocate that to our products in the second stage allocation. So we have, in this instance, support department maintenance, support department accounting, support department personnel. And what we want to do is allocate those costs to our production departments in these first stage allocations. And in the second stage, we're going to allocate our total production department costs to our products. So we can see here that our service departments consist of maintenance department and personnel department, and our production departments consist of assembly and finishing. So we want to, it's an illustration of support department allocation, ignoring this relationship between service departments, the maintenance and personnel. We're just assuming that service department provides all of its services to the production department, and the personnel department provides all of its services to our production departments. So the guidelines for this cost allocation in stage 1, we have to choose an allocation base. We can allocate by behaviour, we can allocate based on actual or budgeted, and we have to decide whether we're going to recognise departmental services. So remember, in the previous slide, we didn't recognise between support department costs, but that's a decision we made when we make when we design our costing system. So selecting allocation base. Remember, we had a number of criteria, and it they included cause and effect, benefits received, fairness and equity, ability to bear. So the most accurate is cause and effect relationship. We might also do it based on the benefits that are received by the production department. The least accurate are using ability to bear or fairness and equity. So it could be anything. It could be the number of personnel in your department, in your production department, or it could be based on, if it's a security support department, it might be based on the square meters in your production department as opposed to another production department, etc. So these are just examples of the types of allocation bases, but you would choose based on your criteria, the most accurate of which is a cause and effect relationship. Allocating costs by behaviour. So if you're using a single rate method, which means that you calculate only one rate for each of your support departments or service departments to allocate to your production departments, that means that there's no distinctions made between your fixed and variable costs, and that's the method that we use in Accounting 2102. But you should, in some companies, they actually split it up into a dual rate. So they separate out their overhead, their support department costs, into a variable cost pool and a fixed cost pool, and that only really makes sense if they have different causation, if there's a different cost allocation base required for each of the types of costs based on whether they're fixed or variable. So the dual rate method would be the most accurate because remember, we know that variable costs behave differently to fixed costs when we're talking about per unit. So the more units or the more cost driver, the lower the variable cost, the fixed cost per unit of the cost driver. But for variable costs, it maintains the same cost per unit of cost driver. So the most accurate method would be the dual rate, but for the purposes of simplicity, we're using a single rate in this course. So are we going to use actual or budgeted allocation base? Under either method, single or dual, the allocation of service costs can be based on one of three options. The budgeted overhead rate by the budgeted hours. Remember, this is normal costing. Sorry, this is standard costing. The budgeted overhead rate by the actual hours is normal costing, or the actual overhead rate by the actual hours is actual. So this is standard. We're not dealing with this yet in this course. Towards the end of semester, we'll introduce you to these. This is standard costing. This is normal. And the final one is actual. Costing. Okay, so whether we choose to use actual or budgeted rates affects the level of uncertainty departments face. So remember we said using a budgeted rate provides more certainty because we can calculate that rate at the beginning of the accounting period. Whereas using actual rates means that we have to wait till the end of the accounting period to calculate the rate. Budgeted rates let the user department know in advance the cost rates that they will be charged so they can make decisions about the use of the cost driver. Users are better able to determine the amount of service that they request from a support department and better prepared both long and short run plans. And the manager of the service department is motivated to improve efficiency because they want to ensure that their actual performance is at least as good as budgeted, if not better. So here, remember what we're doing here in refining our costing system is that we, instead of just having one cost allocation rate, we are allocating our service department cost to our production departments, and then we're allocating the cost from our production departments to our product. So it's a two-step process. The first stage allocation, service department costs, are allocated to production departments, and the second stage, our production department overhead is allocated to our products. So the problem is how to allocate the service department costs or support department costs when our support departments provide services to each other. And here we're going to learn about the direct method, the step-down method, and the reciprocal method of allocating our service or support department costs to our production departments. So by the direct method, what we mean is we ignore the relationship between the interdepartmental services. So we ignore any kind of support department services between support departments. In the step-down method, we partially recognise that one support department might supply services to another, and in the reciprocal method, we fully recognise the provision of services between support departments. So this is the most accurate method and this is the simplest. And you need to be able to calculate using these methods. Direct method for stage 1, allocating between service departments and production departments. The relationship between service departments is ignored, so we just allocate the costs, the overhead costs from the service department to the production department, and this service department to both production departments. So giving it some numbers using the direct method, the first stage allocation, so just from the service department to the production department. So we've got departmental costs for the maintenance department of $90,000 and from the personnel department of $360,000. We know that maintenance and personnel departments, so the maintenance department, the allocation base is the square meters occupied. If we're using the direct method, we only worry about the production department square meters occupied. So that's for maintenance. And for personnel, we're using number of employees. So this amount, departmental cost before allocation, the allocation base is the number of employees in assembly and finishing. We ignored how much of personnel is used by maintenance and how much of maintenance is used by personnel. So we're just worried about this direct relationship, what the service departments do for the production departments, and we're given the allocation bases. So first we want to allocate maintenance, and we were told that we allocate it based on the number of square meters of the production and the assembly and finishing departments. So they're the production departments. So when we allocate the 90,000 between assembly and finishing, we just use as the denominator the 50,000 and the 25,000 number of square meters, and assembly use 50,000, so that becomes our numerator. So we allocate 60,000 of the service department costs to assembly department. And for the finishing department, it only used 25,000 square meters. So same denominator, the amount of square meters for assembly and finishing, and we times that by the 90,000. So the remaining 30,000 is allocated to the finishing department. That was based on the number of employees, and there were 30 employees in assembly and 20 in finishing. So that becomes your denominator. Your numerator is the number of employees in assembly, and we times that by the 360,000. That's the total personnel department costs, and we allocate 216,000 to assembly. And finishing, the numerator just becomes the 20 employees in the finishing department. The denominator remains the same, the finishing and the assembly department. We times that by the 360,000. That gives us the 144,000 that the finishing department is allocated of the support department costs, or the service department costs, of $360,000. So if we add together the costs of the assembly department plus what's allocated from maintenance and what's allocated from personnel, assembly department costs now become $976,000, which we then want to allocate to our product in the second stage allocation. Okay, so we can allocate from the production departments to the products by taking the budgeted overhead costs for that department and divided by the budgeted cost driver. So we got the 976,000, divide that by the 10,000 direct labour hours for assembly. That's how we arrived at the 9760, and same for finishing. So we will allocate to our product from assembly, products, and finishing based on the number of direct labour hours, but they have a different rate for both of those production processes. So we're just going to do a quick check of your understanding if we're using direct method of allocation. And we know that these are our service departments, admin and computing services, and admin uses number of employees as the allocation base, and computing services uses the number of PCs. Remember, we only use, if we're using direct method, we only use the operating or production departments allocation base to allocate admin and computing services. So how much cost will be allocated to administration, from administration to accounting. So remembering on the previous slide, that admin had a total cost of $180,000, and we were allocating admin based on the number of personnel, and in accounting there were 20 personnel, and in computer services there were 80. So to allocate, what we do is we take the 180,000 divided by the total personnel of 100, and if we want to know for accounting how much we're going to allocate, we times that by 20. So we know that we allocate 36,000 of admin to accounting. The remainder we will allocate to computer services based on the fact that they had 80 employees. So we've done the direct method where we ignore both what service department does personnel for maintenance and what maintenance does for personnel. The second method, which is a little more accurate, is the step-down method. So what we do is once a service department's costs are allocated, the other service department's not allowed to allocate back to it. So we recognise one service department services it provides to another, but not back. And that's why it's called step down. And then we allocate from the service departments to the production departments. using the same information. We've got 90,000 of maintenance costs, 360,000 of personnel. We know that maintenance we allocate based on square meters occupied, and personnel we allocate based on the number of employees. So to use step-down method, we have to work out an order of allocation. If you're not told an order, in most cases you will be, the first service department's cost to be transferred is the service department that provides the greatest percentage of total service to other departments. And if that percentage is the same, and then it's the service department with the greatest costs. In this case, just ignore these lines, please. We would allocate personnel costs first since it provides the highest percentage of service to maintenance. So what we see, remember maintenance is allocated based on the square meters that we occupy. So if we calculate the total square meters for all the other departments, not maintenance, so for personnel, assembly and finishing, it's 80,000. So we divide 5,000 by 80,000, that gives us 6%. So personnel uses 6% of maintenance's services. Now remember, personnel is allocated based on the number of employees, which if we add maintenance, assembly and finishing employees, we get 60. So maintenance uses 17% of personnel. So 10 divided by 60, maintenance uses 17% of personnel services, which is more than personnel users of maintenance services. So therefore we allocate personnel services first in the step-down method. So personnel was 360,000. We knew that there were 60 employees in maintenance, assembly and finishing, and 10 employees in maintenance. So we're going to allocate of the 360,000, 60,000 to maintenance, 80,000 because there were 30 employees in assembly, 180,000 to assembly. So that's the same numerator, 10 plus 20 plus 30. That's all the employees in maintenance, assembly and finishing. And 120 to finishing. So there were 20 employees in finishing, same numerator, same denominator, the 10 from maintenance, the 20 from finishing, and the 30 from assembly. So we're going to take 20 divided by 60 times 360,000 gives us 120,000 that we allocate to the finishing department. Now what we have to do, so we've allocated all the 360,000 of personnel across maintenance, assembly and finishing. Now we add together the costs in maintenance, 90 plus 60, and that gives 150,000 that we now have to allocate to assembly and finishing. And remember, we do that on the basis of the total square meters in those departments. Here, we know that in assembly we had 50,000 square meters, and in finishing we had 25,000, so that becomes our denominator. We divide 50,000 from assembly by 75,000, times that by the 150,000 in maintenance. That gives us how much we allocate, $100,000 we allocate from maintenance to assembly. We take the 25,000 square meters in the finishing department, divide by the 50,000 plus the 75,000, and that gives us 50,000 in finishing. So we've allocated all of personnel, all of maintenance, and we end up with a slightly different cost of production department assembly and production department finishing than we did under the direct method, but it's slightly more accurate because what we're doing is we're recognizing that personnel provided some services to maintenance, but we're not recognizing the services maintenance provided to personnel. So it's not the most accurate method, but it's better than the direct method. Finally, using a reciprocal method, we recognize that personnel is providing some services to maintenance, and maintenance is providing some services to personnel. So this is the most accurate method. It's also the most complicated. Okay, using a reciprocal method, we know that the total cost of personnel is the cost of personnel plus what we use of maintenance. So we know that we use 5/80ths of maintenance based on the square meters that we occupy. So we add together the total square meters that maintenance provides to other departments, and we have 5,000 divided by 80,000, the total square meters of maintenance. So personnel costs are the 360,000 in personnel plus what maintenance provides to personnel. The total cost for maintenance is the 90,000 in maintenance plus what personnel provides to maintenance. So we use the number of personnel in each of these departments, and we know that maintenance uses 10/60th of personnel costs. So we can solve these using a reciprocal method, using simultaneous equations. So for personnel, we know the cost is 360,000 plus 5/80ths of maintenance. For maintenance, we know that the cost is 90,000 plus 10/60th of personnel. So we can substitute maintenance in and solve for personnel. So for personnel, we've got 360,000 plus 5/80ths, and we substitute in maintenance, 90,000 plus 10/60ths of personnel. So we can solve this relationship, and we know that personnel total costs 369,474, and for maintenance we substitute in this value for personnel, and we can solve the equation and know that maintenance cost is 151,579. So these are the solutions you'll use to allocate all costs to the other service department and the production departments. So this is substituted in here, here, and we solve for P, and we get 369,000, and then that is substituted in to your M equation, this P here, and we solve for the maintenance department costs. Then using a reciprocal method, we just take those total costs, we allocate based on the number of personnel across the 3 other units. So we take the 10 personnel in maintenance, divide by the total personnel in maintenance, assembly and finishing, and we allocate 61,579 to maintenance. We know that this total allocated across maintenance, assembly and finishing using the amounts of square meters in each of those departments, we can allocate that 9,474, which has already been taken out and allocated across, and we end up with slightly different figures yet again in our production departments. But notice we allocate all of personnel and maintenance ultimately to assembly and finishing. We're just recognizing that in that allocation, the relationship, the reciprocal relationship between personnel and maintenance by using those simultaneous equations. So choosing between methods, the reciprocal method is the most precise, direct and step down and simple to compute and understand. Direct method is widely used, particularly if the production departments use much more of the services than of the service departments than each of the service departments uses of each other. Okay, so that's a lot to take in. We've covered this idea that we want to refine costing systems depending on our product and our production process. because traditional plant-wide rate may not be accurate enough to reflect the use by different products of different resources. In this case today we've talked about the resources being the service department resources, the costs of service departments, and different production departments are used differently by different products. And we learnt the step down, the direct, the step down, and the reciprocal method for that type of allocation. So that was the departmental allocation approach. Next week, or next lecture, we're going to talk about activity-based costing, which is an even more refined costing system than using a departmental costing system. And it's more, we recognize that resources cost money and activities use resources, and those activities are what drives a particular cost object to use resources differently. And in activity-based costing, we recognize that different levels of activities, some activities are unit based, some are based on batch of a product, some are product sustaining activities, and some are facility sustaining activities. And the allocation bases are also then based on these activity levels and not on traditional volume bases. Previously we've talked about using the number of units or the number of direct labour hours or the number of machine hours. They're volume bases. In activity-based costing, we recognise there's a cost hierarchy and that some costs are driven by the number of units, some are driven by the batches, some are product sustaining costs, and some are facility sustaining costs. And these allocation bases in these different levels of the hierarchy are based on these activity levels and not on traditional volume bases. So in an activity-based costing system, which we're going to cover in the next class, which is a further cost system refinement, a more refined system than a traditional or a department-based system, we gather together our overhead costs and we allocate those overhead costs to these different activities. And then those activities are allocated based on different cost allocation bases to different cost objects. So that's why it's called activity-based costing. We're recognizing that different activities at different levels of the hierarchy use resources which cost money, and so those activities are driving the costs, the overhead costs, and that's how we're going to allocate costs to our cost objects. So the next lecture we're going to do activity-based costing and activity-based management. Now remember your online quiz, which takes place on the 28th of August, in the time that is your lecture time. So whether you're enrolled in lecture 1, your online quiz will have to be started between 8 AM and 10 AM on Wednesday the 28th, or if you're enrolled in lecture 2, you'll have to start your online quiz between 2 and 4 PM. You need to ensure that you have a reliable internet connection and computer access for your online quiz, and that online quiz will cover the material in lectures 1 to 4 and the associated tutorials. So lecture 5 is not on the online quiz, but it is very important because your first case will be about activity-based costing, and it's a very important technique for you to learn for your future careers. So please try to keep up. Please attend your lecture next week on activity-based costing and your tutorial for the material covered in this week's lecture which will be covered in the online quiz. Also in Lecture 5, I will be giving you more information and instruction about the online quiz, which is very important for you to understand, because you want to ensure that you're as efficient and effective in the 90 minutes that you have to complete your online quiz. So thank you for listening and have a good week, and I look forward to seeing you at the lecture next week.